So, so what is the alchemy of SQGLP? I mean, this is our terminology. How do we, I mean, you have to find, you have to give some shape to the entire investing process, and how do you justify, I mean, how do I look at it? Because there are million guys, million ways of looking at it, but this is our style of looking at it. And everybody will fall into this, they may call it differently. So size, I think one of the most distinguishing feature of all these 47 companies is that they're small to start with. Small, both in market cap and sales. They are very profitable companies, but very small and modest. The average revenue of this, all these 47 companies is, I think, about 250 crores, but the largest is about 650 crores. So clearly, we are talking about very small companies, though you have to adjust for the time factor. 10, 15 years back, these companies were small. But today, if you want to start, I would think that $500 million is a good number. So you can go up to 3,000 crores to start with. So first thing is it has to be small. Second, which is more important, it has to be relatively unknown. So you have to walk alone. When you find something, don't tell to, I mean, even if you tell any people, he's not going to appreciate because you only know the story. So it is good that you keep telling and nobody acknowledges that it is a good story, then it is a good story. So, I mean, I have seen it time and again. Nobody accepts it. That's why it is unknown. So, whatever you know, whatever is your insight, but that vision has to be, has to be believed that it is unknown. And what happens is when it is unknown and you tell your 5 friends who are most brilliant and they reject it, then you think that you also start believing that it is a bad idea. And then you don't buy. So that's where when you vision it, you also must have courage to act on your own conviction. You can keep doing analysis, paralysis, as it is called. But you have to someday act, and act with a courage, where you allocate 5%, 10% of your net worth. So if you're a 100 crore guy, I mean, buy 10, 15, 20 crores worth of stuff. Because what you have in the portfolio, which is the largest allocation, say 20%, 15%, they are fat guys. I mean, one company which has made you big, but that cannot grow from there at that pace. So you have to see that the growth potential here is the highest, and hence you must, with courage, you must allocate much more. And that's what really makes a difference in the wealth creation. So small and relatively unknown. The next is the quality. The quality of business, quality of management. You have to have high quality business. What do you mean by high quality business? It has to be a business where generally there is a lot of profit, or a lot of profit potential is there. I would like to see a business where profits are already there, say banking, financial services, pharma, IT, consumer products. So when a new businessman comes in that particular field, it is much easier for you to figure out whether he's going to make money or not. But somebody starts making money in, say, airlines, where there is no money. Not only in India, there is no money in the world. And then somebody comes and, sir, I made 100 crores profit, would you like to buy? I'm not interested in buying that. Because I'm not saying that company may not prosper. It may prosper, but it will be headwinded, in the sense that, I mean, I don't want to apply my mind, because the tailwind is not on his side for the business in the long run. Today he's making money, after 2 years again it might go bankrupt. So it is better to stay in the businesses where there are large profit pools, which is there today in India in IT, pharma, banking, consumer, maybe in oil and gas now. Then it has to be one of the things is that value migration. I mean, one of the biggest value migration which is on right now. Value migration is the round the clock somewhere in the world, in some products, some company it is always on. But right now, $1 trillion value migration is on between the software, in the software industry from the developed world to developing country, more particularly like India. So from a $60, $70 per hour cost in Boston, all the work is coming here at $6 or $10, $15 per hour in Bangalore. And it's a huge trend, nobody can stop it. Even if the US government wants or anybody wants, they cannot stop it. So this migration is, just look at the size of the migration. In 2000, software services industry globally was about 500 billion. And we were 5 billion, so we were 1%. Today it is 960 billion, we are 100 billion, we are 10%. So we're given 10% share in the global software services. And the world is going nuts, they are going digital. So in next 10 years, probably the services will go to 2 trillion in 15 years. What will be our share? This year our share is about 35, 40%. Would it be 500 billion, 600 billion in next 10 years? So that's what is staring at us. And that's a huge opportunity. Which companies are going to make it, that is for the guys. So we have to keep looking at generic migration in banking from public sector to private sector. I mean, will the public sector become, something like Doordarshan types? But that is 70% of the market. So there's a huge tailwind for the private sector, NBFCs and banks. So, so that you can keep going, say like strategic niche opportunities. Like in a 15, 17 million motorcycle market, you have a Aisha which does just about 300,000, but makes money hand over fist. They're on seller's market, they're not on the buyer's market. So they can charge their price. Steel prices going down, petroleum product prices going down, they will raise the prices. So that kind of niche is required. Dominant share, Pidilite, United Spirits. I mean, this is the youngest country in the world, 50% market share with brown spirits and United Spirits. I mean, they're going to make money. The best business, best manager. How much money they can make, only time will tell. So economic mode, like Bosch. Bosch is almost 70%, 80% market share. I mean, no automotive in diesel will move without Bosch. So all the development, all the river linking, all the road making, all these guys, they have to buy diesel system and it has to be supplied by these guys. So there is massive money to be made. How much, I don't know. So I think you have to have your own themes, your own framework. There are many more frameworks which we have not put here, but you would be having, and you have to use them before you identify the idea. Quality of management, I think this is the most important one, more important than the business. Highest integrity, I mean, I think, first thing is the competence. I think competence has to be highest, which in India you find all over. The guys are very, very competent. Integrity, you never find in India. It's the most rare commodity in India. So you have to find competence and integrity. I think I always struggle with this, but I think I'm becoming better with the mistakes. I mean, more recently, the mistakes we have committed, that is making me better. I hope I'm becoming better. And then third is, which is most important for this kind of companies, is growth mindset, the passion, the 24/7 urge to take the company forward. The growth has to be kept going. And growth has to be kept going not by the external forces, by the internal management forces. And that is what is the differentiating between a company in the same field than other company. So you need the transition of the management so that you can keep importing new energy at the top end. The moment the top end energy goes away, you've seen in Infosys, the moment Narayan Murthy and Nandan's energy went away, they didn't replace with the good energy. Now they're replaced with, I think, new horsepower. So hopefully it takes it again forward. So you need the growth mindset and passionate 24/7 physical raw pulling power. And so what happens is, at this juncture, it is said by Phil Fisher in one of the books that 90% is management, 9% is business, everything else is 1%. Keep that ratio in mind. So pick up the guys who are really big blasters. Now, what happens is, the growth is not only about sales growth. There is a sales growth itself is two parts: sales volume growth, sales realization growth. So it is a multiplicative kind of thing. If you read the report, then you realize volume growth multiplied by price growth multiplied by margin growth means cost reduction, multiplied by valuation growth. So you have 4 or 5 levers. People are focused only onto the valuation situation. 40p is very expensive. Don't touch it. I mean, yes, it might be right in most of the situation, but you can, if somebody tells me it is 40p, but margin is going to go 3 times more or 2 times more, then for me, effectively, it is 17, 18p or 20p. I'm very happy to do that because nobody is focused onto the margin growth. And it is all multiplicative. Volume multiplied by price growth, unit price growth, multiplied by margin growth, multiplied by P growth or valuation growth, whatever, price to book, price to earnings, whatever. So when you understand all 4, then only you get the total growth. So you have to get 25, 27, 30% every year out of all 4 multiplied. So you have to be insightful about one of them. That also is good enough. Like every company has a different thing. Like Infosys has grown 45% compounded sales growth, flat, straight, no margin expansion. Actually, margin has contracted, even P has contracted from 40, 45 to 15, 17, whatever. So it was a one-legged horse straight on the sales growth. But most of the companies like Bata has done some 62%. I was seeing in this somewhere. Bata has, the volume growth is not more than, not even double digit. It's about 10-12%. But price growth is 5-7%. Margin expansion is massive, almost 10-15% every year. And then P expansion. So all four combined have given you 62%. So you have to be insightful about how this, all these variables work. I think this is the classic one. The confusion between quality and growth. You know, one of the things I found, maybe it is in my mind, but one of the things I find, and I was not able to resolve for a very long time, is that all the great companies or great businesses, are they good investments? And I was not getting answer. If you have bought Colgate, I think you can't go wrong having big portion of your investment in Colgate, but it has not done well. If you see 20 years, it has just done about single digit, 9-10% compounded. It's the greatest franchise in India. Why? The earnings have grown at about 10-11% last 20 years. And it started with 80-90 P, and today it is maybe 45-50 P. So actually there's a D-rating, and eventually you made just about 9-10%. So you are not become, you've done well, reasonably well. You've beaten the inflation, but you have not beaten the index, and you have not done very well. But at the same time, say like HDFC Bank, it's not as great a franchise as Colgate, but it has grown at 26-27% earnings, and P multiple was about 20 to start with, now also 20. You made 26% compounded. In 20 years, you do a differential between 10% and 26%. I don't think, it makes great sense to stay with the quality but slow growth, particularly in this country where inflation is very high, and pay a very high price for high quality, low growth. So there are four quadrants: low growth, low profit. Sorry, low quality, low growth. It's a complete disaster, very avoidable. Low quality, high growth. That's the trap. And you need to be master of that, in the sense that you buy low and sell before others sell it. So, but it's a troublesome. Most of the retail, they get sucked into this. And they buy at the top, they only make the top, and then they become long-term investors and they sell it at a 80-90% lower price. Or they wait for the next bull run so that they can cover it. So, that's another troublesome spot. So in high quality, again you get, high quality, but low growth. So this Colgate types, so you cannot die, you will do okay, but you can't amass big wealth. The real certified enduring multi-bagger or big growing happens on the top right. That is high quality, high growth. And if you can buy it at reasonable price, growth adjusted, I think you'll do very well. But that's where you have to position the entire portfolio very, very rightly. Markets are not positioned like that. Here you can't find ideas every day. You may find one idea in a year, two ideas in a year, maybe no idea in a year. But you have to be building your portfolio slowly. I think longevity has been the old subject, but longevity of goodness and longevity of growth. When quality, growth, and longevity of goodness and longevity of growth, when all these 3-4 things come together, it becomes completely goofy for the market to figure out what is the right valuation. So we want to confuse the market by having the characteristics which market cannot fathom very, very easily. So what happens is, you have a Asian Paints, or you have a iShares, or you have a, say, even Infosys or whatever. So they start with they're great businesses, they start with high ROE, and then the competition comes and hits them. But you need to have the entry barriers or whatever advantage you have, and the long-lasting advantage. You have a brand, you have patent, you have low raw material cost, you have the scale, nobody can touch you. So that's what guarantees you continued profit for 10, 15, 20 years. So longevity of the advantage is very important. And that's what happens is, the market thinks that this company is good for next 10 years. Then after 10 years, you realize that this company is again good for 10 years. This is what happened with Asian Paints for me. In 91, I identified it's a terrific company, but I found it expensive. I thought next 10 years, profit is already discounted, so let's not buy it 20p. Then after 10 years, I realized that this is a very good company. So I was willing to pay 20p. Then by that time, the P multiple was 25, because market was discounted next 10 years. Then when I got agree for 25, then it went to 35. So I'm still not bought. So, this is what happens with the true blue chips, which have a rolling cap period extending. Then you have the price. I think this is the last piece of, we go exactly in the same order. Price is the last. Because unless you have understood the entire spectrum of the real architecture of the company, you cannot value it. So valuation has to be favorable. It need not be dirt cheap, but because when it is very small, in any case, the option value is very high. So valuation, per se low value, I mean, if you start with 5, 6p, which you rarely become, what you call, lucky to get that, then it lowers your, like when Infosys came, it must have been about 7, 8p multiple at 50 crores. So, you know, it went up 7 times in first 12 months. So it lowers your total effort required to go to 100x big time. I mean, if you can do 5, 6x very quickly, then like in Hero Honda, I think between 96 and 2003, we were up about, say, 17, 18 times. So what was required to be done for next 12, 14 years, only 7, 8 times. You know, so actually when we analyze, we realize that in 7 years, we did almost 20 times, and rest all 5 times has happened in 10 years. So I've made very little money in last 10 years, but I was not aware of it. So typically, this is what really happens. You got to buy a little more reasonably priced. As is said, that for human beings, there is no substitute of love. For investing, there is no substitute for paying right price. So, so how to apply for the future? Now we come to the almost last part of the presentation here. I mean, we have tried to look at it. I mean, we have not done a lot of work, but we just tried to show you how to go about it. Like market cap below 2,000, 3,000 crores, likely beneficiary of value migration or niche opportunity, P less than 25x currently. So this is definitely not a full research. It is just a screener we have done, and there is a potential that there must be something here. So, I mean, because of SEBI, you know, we have put this, you know. So these are companies which are looking to be good, but we need to do a lot of work. None of them are finalized as a recommendation, but these are companies which have good starting screener to look at. I mean, they are less than 2,000, 3,000 crores market cap, maybe around 1,000 crores. They are reasonably good management. They have reasonably good business. They have a longevity opportunity. So everything is in place, but we have not interviewed any of the managements. So we have to go and sharpen our own understanding of these businesses to figure out whether there is any one of them which is worth betting on. I think market outlook is not very important because, but have some thoughts. I have some thoughts on this, that market cap to GDP, sorry, profit to GDP, total aggregate corporate profit to GDP has almost bottomed out about 4.4%. This is the first year when the corporate profit growth will track the nominal GDP growth rate, about 11, 12% types. So I think this 4.4 is the bottom, and the peak is about 7.8%. So as the GDP gathers momentum, nominal GDP grows at about 11, 12, 13%. Most likely, in say 6 years, if GDP doubles, or I mean probably in 6 years, corporate profits has a potential to go 4 times. And since valuation is reasonable, I think markets can have that kind of attraction going forward. So interest rate is, the discounting factor is looking to be headed down to more like 5% all-time low. Particularly the oil thing is not still factored. So still we are counting, Mr. Rajan is taking his own time, but my sense is we are headed for record low in terms of interest rate. Let's see where it stops. Because what's happening in oil is unprecedented. This is as big as bubble burst. It's an oil bubble burst. Energy table has completely slumped, and it will have huge repercussions across the industries and businesses, and market has not even moved 10% on that. So I think there is a huge, in next 2-3 quarters, it will be clear who is benefited, who has lost, and what is the global implication of this. So, but I think for India, it is a amazing development. One factor where market looks very reasonable is here, the market cap to GDP, which is a very broad ratio. It doesn't look at anything else, just the one number. So we are at about 0.77 or maybe 0.8, something like that, because GDP is about 121, 122 lakh crores for the current year, and market cap is around 99, 100 lakh crores. So we are in this sweet spot right now. I think we have gone in 2007 to the peak of 1.8, and now it is about, as I said, 0.8. So on a 1.5 year basis, when we'll be at about 135 lakh crores of GDP, we are at 100. So if we move from here to say 130, in next to 15, 17 months to 135 lakhs also, I think we could be doing more like 35, 40% appreciation in next. It's a very good number to talk about. I don't want to predict, but that kind of potential is there if everything falls in place. Oil has fallen in place, interest rate will fall in place. I hope the investment cycle, which is very well awaited, also finds place. In the sense that the kind of pressure, all kinds of nuclear deal and auto deal and bullet train deals, and those things are being built up. Maybe it will take some time. We are losing patience. And if market loses patience, I think that will be the God-sent opportunity to put in whatever is left to be put in the market. And the people who want to get back into the, put more money into the market, in fact, they should pray to the God that let the market come down by 10% so that they can put everything, rather than saying that let the market not correct. This is how the markets look in terms of P multiple. We are at about just above the average at about 16, 17 times. So in conclusion, 100x stocks are few, very few. Please mind it. It's not even 1 out of 50 in a common situation. It takes little while to find multi-baggers. 100x stocks are few. Finding them requires vision to see, courage to buy, and most important, patience to hold. It is said in that book that patience is rarer of the all three, and I think ladies seldom have it, and men never have it. So it is so difficult to have this patience, and in this dynamic, nanosecond price change. So that's the most important one. Value migration offers the most predictable 100x opportunities right now, and it is not a local value migration, it's a global value migration. 100x processes are captured in SQGLP. In evaluating a common stock, the management is 90%, industry is 9%, and all other factors is just about a percentage. So focus on quality of management. Quality does not guarantee growth and in turn rapid long-term wealth creation. You need to have growth and quality both. Subject to global factors, expect 50% upside in the market in next 2 years as market cap moves more towards GDP parity. Thank you very much.
Thank you very much, Mr. Agrawal. I think you've given everybody a lot of confidence to write a lot of checks going here. But this brings us to the last part of today's evening. It was indeed a very thought-provoking and stimulating presentation. And speaking of thought-provoking, we all know that a discussion always brings out best thoughts and ideas. So to have a more meaningful discussion on what Mr. Agrawal has already presented, we have our set of capital market experts who will come across and debate further on what Mr. Agrawal has presented.